Let's talk about what's happening with your money right now, January 3rd, 2026. It's a new year, but the financial landscape is anything but ordinary. As you check your phone for the latest headlines, you might notice a strange disconnect between the news from Wall Street and what's happening in everyday life. The numbers look great on paper, but what do they really mean for you and your community? Investors are pouring record amounts into the US stock market. Just look at the Vanguard S&P 500 ETF, which saw $125 billion in inflows last year. That's more money than ever before, and it's fueling a surge in stock prices. The excitement is palpable on trading floors, with analysts and investors celebrating what seems like an unstoppable rally. For many, it feels like a golden age of investing, with portfolios swelling and optimism running high. But while money floods in, jobs are flooding out. 1.2 million layoffs in 2025, the most since the pandemic. Behind the scenes, companies are cutting costs, automating roles, and restructuring teams. For millions of workers, the reality is far from the euphoria of the markets. Families are facing uncertainty, and communities are feeling the strain as more people find themselves out of work. Wall Street is celebrating, but Main Street is hurting. The divide between financial markets and the real economy has never felt wider. While traders cheer record highs, small business owners and workers are left wondering how they'll make ends meet. The prosperity on the trading floor isn't translating to the streets where most people live and work. This is a fundamental contradiction. Soaring markets, but a faltering job market. It's a paradox that's hard to ignore. The numbers on Wall Street keep climbing, but the number of people out of work is rising too. The disconnect is creating confusion and anxiety for anyone trying to make sense of their financial future. The illusion of prosperity is powerful, luring investors into a false sense of security. When you see your investments growing, it's easy to believe everything is fine. But beneath the surface, the foundations of the economy are shifting. Many are celebrating gains without realizing the risks that are quietly building up. Can a market keep rising while the real economy cracks? History says no. Time and again, we've seen bubbles burst when the gap between Wall Street and Main Street grows too wide. The warning signs are there for those willing to look beyond the headlines and dig deeper into the data. Sooner or later, reality catches up. The clock is ticking, and the consequences of this imbalance could be severe. When the market finally reacts to the underlying weakness, the fallout can be swift and dramatic, impacting everyone from seasoned investors to everyday families. Understanding this imbalance is the first step to protecting your money. By staying informed and looking beyond the surface, you can make smarter decisions and prepare for whatever comes next in this unpredictable financial landscape. Think of the unemployment rate as a warning light on your economic dashboard. Just like a flashing light on your car's dashboard signals that something under the hood needs attention, a rising unemployment rate is a signal that the economy may be heading for trouble. It's one of the most visible and immediate indicators that something fundamental is changing in the job market, and by extension, the broader economy. And right now, it's flashing red. This isn't just a minor flicker. It's a clear, urgent alert that demands attention from investors, policymakers, and everyday people alike. The U.S. unemployment rate has climbed to 4.6%, triggering the SOM rule, a historically reliable recession signal. The SOM rule is simple but powerful. When the unemployment rate rises by half a percentage point or more from its recent low, it has almost always meant a recession is either underway or about to begin. This rule's track record is nearly perfect. When unemployment rises this fast, a recession usually follows. It's not just a theory. It's been proven time and again over decades of economic history. Economists and analysts watch this signal closely because it's one of the few indicators that rarely gives a false alarm. A healthy economy depends on people having jobs. When employment is strong, people have money to spend, businesses grow, and confidence spreads throughout the economy. Jobs are the foundation of economic stability and growth. When layoffs rise, spending falls, and corporate profits suffer. As more people lose their jobs, they cut back on purchases, which in turn hurts businesses and can lead to even more layoffs. A vicious cycle that can quickly spiral. Stocks are just pieces of businesses, and businesses can't thrive if customers are struggling. When consumers tighten their belts, companies see lower sales, and that's reflected in falling stock prices. History shows that some of the worst market crashes began just as unemployment started to climb. The connection between job losses and market downturns is strong. and ignoring it has led to painful lessons for investors in the past. Investors who ignored these signals were blindsided. Many believed the market would keep rising, only to be caught off guard when reality set in and stocks tumbled. The rising unemployment rate is a clear sign of economic trouble, even as the market rallies. Ignoring it is dangerous. It's easy to get swept up in optimism when stocks are up, but the underlying data tells a different story. Don't let the party on Wall Street distract you from the warning signs. Staying alert to these signals can help you make smarter decisions and avoid being caught off guard when the economic tide turns. Many see an unsettling parallel to 2008. Back then, the S&P 500 hit new highs, the Fed cut rates, and margin debt soared, just like today. Investors borrowed heavily to chase gains, ignoring early signs of trouble as unemployment ticked up. The result? A devastating crash. Today, the same ingredients are mixing: record-high markets, Fed rate cuts, surging margin debt, and rising unemployment. Bears warn we're repeating history: markets detached from economic reality, and rate cuts signaling desperation, not safety. They argue today's inflows are a frantic blow-off top, not a sign of strength. The lesson: easy money and rising prices can mask deep problems. Don't get trapped by the same mistakes of 2008. The warning signs are here. Will you heed them? But not everyone sees doom ahead. Some see a repeat of 1999. Bulls argue that a tech-driven revolution, not unemployment, is the real story. S&P 500 earnings are accelerating, thanks almost entirely to the information and technology sector's explosive 21% growth in 2025. The driver? Artificial intelligence, which is transforming business and boosting profits. Bulls compare today's AI boom to the internet boom of the late 90s. Tech earnings soared even as other sectors lagged. The Fed is still cutting rates, fueling the rally. Bulls believe as long as tech earnings climb and money stays cheap, the market can keep rising. For them, this isn't a house of cards. It's the start of a new era. The question: can this tech momentum last? Technology, especially artificial intelligence, is the engine powering today's market, transforming the way businesses operate and how investors think about the future. From the heart of data centers to the fingertips of everyday users, AI is reshaping industries at a pace we've never seen before. AI is no longer just a buzzword or a futuristic dream. It's driving real profits by automating repetitive tasks, slashing operational costs, and enabling the creation of innovative products and services that were unimaginable just a decade ago. Companies are leveraging AI to streamline supply chains, personalize customer experiences, and even predict market trends with remarkable accuracy. The information and technology sector's projected 21% earnings growth in 2025 has propped up the entire S&P 500, making tech the backbone of the current market rally. Without this explosive growth, the broader market would look far less impressive. But this concentration comes with significant risk. The market's fate now rests on the performance of just a handful of tech giants. Their dominance means that any stumble could send shockwaves through the entire financial system. If these leading companies falter, the impact will be huge, potentially dragging down portfolios and retirement accounts across the globe. Investors are paying sky-high prices for tech stocks, betting on even more spectacular growth in the years ahead. The optimism is palpable, and the fear of missing out is driving valuations to new heights. This moment echoes 1999, when internet stocks soared far ahead of their actual earnings, until the bubble burst and fortunes evaporated almost overnight. The parallels are hard to ignore. The big question now is whether AI's promise can truly justify these sky-high valuations, or if we're simply repeating history with a new cast of characters and technologies. Tech is undeniably driving the rally, but the risks are real and growing. Investors must weigh the potential for innovation against the dangers of overexuberance. Don't ignore the lessons of past bubbles. History has a way of repeating itself when caution is thrown to the wind. The Federal Reserve is the market's most powerful force. When the Fed cuts rates, borrowing gets cheaper, pushing investors out of cash and bonds and into riskier assets like stocks. This easy money environment is fueling the current rally. The Fed started cutting rates in late 2023 to fight economic slowdown and layoffs. But cheap money can inflate markets even as the real economy weakens. Sometimes bad economic news is good for stocks. Investors bet on more rate cuts, sending prices higher. This creates a disconnect. Wall Street soars while Main Street struggles. The Fed's actions can drive markets up, but they can't fix underlying economic problems. Don't mistake rising markets for a healthy economy. Rate cuts are a double-edged sword. Beyond numbers and policies, human psychology drives markets, especially fear and greed. FOMO, fear of missing out, pushes people to chase gains as markets hit new highs. Social media and news amplify the euphoria, making it hard to stay disciplined. This herd mentality leads people to buy at the top, ignoring real risks like record layoffs. The belief that this time is different is dangerous. Bubbles form when emotion overrides reason, creating a feedback loop of rising prices. But bubbles always burst. Fundamentals eventually matter. Those who buy at the peak driven by emotion get hurt most. Don't let short-term excitement cloud your judgment. To avoid the trap, think in two timelines, short-term and long-term. In the short term, markets can keep rising even when overvalued. Momentum and easy money are powerful. Bulls may be right for now. Selling too soon could mean missing more gains. But over the long term, high starting valuations predict low future returns. Today's S&P 500 PE ratio is at one of its most expensive points in a century. Buying now may bring short-term rewards, but likely sets you up for a decade of disappointment. It's like buying a house at the peak of a bubble. It could take years just to break even. History is clear. High prices today mean modest returns tomorrow. Don't sacrifice your future for a quick win. We're at a crossroads. AI-fueled optimism on one side, recession warnings on the other. You can't control the Fed, tech earnings, or the market's next move, but you can control your actions. Don't chase the rally or gamble on quick profits. Stick to a disciplined plan. Invest regularly, dollar-cost average, and avoid emotional decisions. Diversify. Don't put everything in tech or any single sector. Build a portfolio that can weather different economic storms. Recognize that short-term gains may come, but long-term returns from these prices will likely be low. Don't risk your future for a fleeting thrill. The financial trap is set. Don't fall for the illusion of easy money. Stay disciplined, diversified, and focused on your long-term goals. That's how you protect your financial future. Build on rock, not sand.